Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be taking a look at 6 steel industry stocks. I had a question about STLD, which is up on my, or a request for that, which is up on my whiteboard here. And I had a good response from my auto manufacturing video where I covered like 10 auto stocks, just sort of shared what I thought about them. And for some of them I had some buy prices and got a good response. People seem to like kind of these kind of industry overviews where I just kind of share my thoughts on the individual stocks within an industry in the same video. So since I had a request for a steel stock, that's what we're going to do in this video. If you have a request, just drop it down in the comments. If it's an individual ticker, I'll get it up on the whiteboard behind me. Eventually I'll make a video. I've been a little bit slow lately making videos, but I will continue to keep working and putting them out whenever I can. As always, this is not individual investing advice. This is just how I analyze stocks. You're going to see me use fast graphs a lot in this video for most of it. I do have a 25% off affiliate link down in the description if you want to give fast graphs a try. It's pretty useful, especially when sifting through stocks like I'm going to do here. The initial step of determining the historical cyclicality of earnings, and then just the overall general trend of like the past 20 years. And if it's not a cyclical, these are almost always all going to be cyclical in the steel industry, but if it's not a cyclical stock, then fast graphs is also really useful determining valuations, and it does a lot of that initial heavy lifting before you can kind of dig into things a little bit more. And that can allow you to sift through more stocks quickly, kind of eliminate them quickly. I have several videos on that where I just go through like 40 or 50 stocks and tell everybody how I'm thinking about it when I initially look at them, which is kind of what this video is going to be about as well. So, and I also have links to Patreon, links to the full Cyclical Investors Club service on Seeking Alpha. Those are all down in the description. All right. I decided I'd start with good old US Steel. This dark green shaded area on the fast graph here represents their earnings per share. So what we can see here is they had a very big upcycle going into the Great Recession. I think probably some of this had to do with probably the fracking boom. I don't know for sure, but we had to build out a lot of infrastructure for that in the US. When you think of like pipelines, you think of drilling rigs. I mean, you think of kind of the amount of steel that would go in, even offshore. You think of the amount of steel that goes into that kind of stuff. In my mind, like that probably was a catalyst for. And then, of course, you know, we had a pretty decent world economy at that time too, until disaster struck. And really, they never recovered from that, right? They had negative earnings for a couple years. Every now and then they pop up and make a profit. And it wasn't until the post-COVID boom that they had another boom, which we're going to see this is going to be a pattern. It's a pattern with a lot of industrial stocks that work in the goods economy. And then it's just a pattern with a lot of cyclical stocks in general, because we had a lot of stimulus, a lot of kind of shifting. Well, stimulus money just works its way through, right? And people want a lot of stuff and they're willing to pay more for it. And then eventually it allows companies to charge more money, right? So that's what we see here with this boom. But now we see that this is coming down. So step one, I would say we do have plenty of history with US Steel for sure. Even in this graph, we have 20 years, but if you wanted to go back farther, you could. The two things that I look for a cyclical, and we know it's cyclical, right? Because the earnings fell 162% in 1 year. My rough threshold for determining whether to treat something as a deep cyclical or just make adjustments for earnings fluctuations, which the vast majority of businesses have earnings fluctuations. But if they're over 50% during a downturn, you can tell it's like economically related or related to their industry. It's not just like a freaky one-off thing. Then that is going to be a cyclical business. But when I'm looking to invest, I want high quality cyclicals, because generally cyclical businesses have a lot of overhead fixed costs. And so when demand falls below those costs that they can't adjust very much, right? If you think of like a big foundry or something, a lot of those costs are kind of fixed in. Then they can lose money, right? And if the downturn lasts too long, when you're losing money, like you can go bankrupt, or you can basically become permanently damaged and not have the earnings recover, and therefore not have the stock price recover. So the two things that I really like to see when I'm looking for a high quality cyclical to try to buy, somewhere near the bottom or at some point off the high. It doesn't have to be right at the bottom. Is I want to see a pattern where earnings have fully recovered. So I want to see where this dark green area has fully recovered. And I want to see that the stock price is fully recovered from the previous peak in a timely manner. So earnings have still never recovered, even during the COVID boom for these guys. And the stock prices didn't even really come close to like recovering. So now it's possible this was some sort of a super cycle, but even if we took 2006's earnings, earnings peak and stock price peak, they haven't even recovered there. And the general trend until we had this kind of post-COVID infusion of money into the economy was flat to down. So this is the opposite of basically what I want to see when looking at a cyclical. So this one would not be high enough quality for me to consider buying. So I actually don't think I track any of these steel companies. I didn't check for sure. The ones in S&P 500, Nucor, I might, just because I usually try to do some kind of tracking on all the S&P 500 stocks. But I'll just say up front that usually steel isn't like my favorite cyclical to like go after. A lot of them look like this, and this really isn't the pattern that I want. But I am going to go through all these individually so we can see. So next, I'm going to look at Cleveland-Cliffs. So they're a smaller steel business. So $6 billion, $9 billion if you include their debt. And we see kind of a similar pattern. We have this, and this definitely looks like it has to do with fracking because it recovered during 2012 and then had a horrible super down cycle. And that's exactly what Cleveland-Cliffs did. So maybe we're getting a little clearer picture with a little smaller business. However, you can also see that their stock price did pretty much recover and earnings did pretty much recover from the 2008 peak. But the problem is after that, if you look at a normal industrial stock, most of them recovered by 2018 and usually before that, but 2018 was kind of another peak for a lot of industrial stocks. And we got nothing here. Like this was not even close to so we basically have the same problem that we have with US Steel. But what I would say is there are some signs here that for the intrepid investor, they really did come down off the super cycle and bottom in 2015. Even though they didn't make a full recovery, you can see earnings did come back pretty good. So since then, they have a little bit, there's like signs of life here potentially in terms of trying to build off that super cyclical bottom. I actually have a 12-minute long video over on Patreon, which is only $5 a month, because I will take requests, and this was requested a couple months ago, where I kind of just go through and kind of explain some of the stuff that I'm talking about now, but it's just about Cleveland-Cliffs basically, where I get into what it looks like some of their acquisition strategy and stuff might be. I just kind of speculate on a few of those things. But to me, if I just pulled this up, I didn't know anything about it, I would avoid it because the basic trend here is probably down, and it's going to be really hard to try to figure out how far this stock could actually fall. By the way, people ask me about this stock all the time. Not all the time, but I mean, I had some requests back here, and I was just like, it's just too hard. You don't know what's going to happen, and I don't know how far down it is right now, but it's 60% at least off its highs. So people got sucked into this boom bust, and it's one of those where I was just like, I don't know. I don't know if this is the bottom. I don't know, I don't know what's going to happen here. So if I don't feel like I have confidence, then I don't step in. If we go back to 2020, I mean, it was at $7 a share. That's still 50% lower than where it is now. So I just try to steer clear when things look too hard like this. Another one I occasionally get questions about, and I think I usually have the same answer, is I think this is pronounced VALE instead of VALE. I think they're Brazilian. Yes, Brazilian steel. Very big compared to the first two that we looked at. So huge steel company. Now, this one is a little bit different, right? We kind of have that similar pattern here where we have a double kind of earnings peak, close to a double, if we take this little super spike off, close to a double stock peak, a horrible downturn, right? During this industrial downturn and fracking bust, oil bust, energy, that's mostly kind of external stuff. It's nothing like internal to their business. And then they start to recover, which looks pretty reasonably good. I mean, if you count all this as like some kind of super cycle. And then we get this other boost. So, I mean, this is kind of exactly, of course, they're so big, they should kind of display the overall general pattern that we see. But again, the question is, when you have a big, if we count this as like some kind of a super cycle, and we count this as a super down cycle, which I think it was, honestly, especially if you go from the tippy top peak up here, and we have a recovery, and you want to reset all this to like 2015, a person could do that. But the problem is we don't really have a post super cycle down cycle to like examine. Like we haven't had like a normal recession or anything. And it makes it really hard with a cyclical business. Let's take this off so we can get a better idea of the fluctuation of the stock price. So I don't know what this drawdown is going to be. Over 50%, right? So I guess that was a little bit of a recession at the last, COVID blip there that they bounced back from immediately. But when you say, okay, well, that's all the data we have. We know that they can, well, that's useful still. We know they can fall more than 50%. So you don't want to get too optimistic. They're down about the same amount now, about 55%. But there hasn't really been like a big recession yet, right? If we look at earnings, they're still not too bad, and they're even expected to kind of level off this year. Now, whether that actually happens, I don't know. But it's just so hard to call that down cycle. And generally, being a Brazilian company, I own some Brazilian stocks. But if I have a choice between a U.S. steel company and a Brazilian steel company, it's just less complicated if you're in the U.S. or probably even if you're in Europe to own the U.S. one. I feel like I understand, the culture a little bit more, understand the currency risk or lack thereof. And so while I wouldn't say, I would never buy VALE when I have choices that are more U.S. centered, that if I find one here soon, which I should, to have, a decent amount of quality, I probably lean that direction more just because I have more confidence about the runnings of the business and everything. So that's my thoughts here. Next, let's look at Reliance. I actually haven't looked at these guys before until just now. So until just before I started this video. Let's see, they are 15 billion, so a pretty decent size. And it says they are based in the US, right? BBB+ credit rating, so that's pretty good. Now, they don't look nearly as cyclical as the other steel stocks that we've looked at so far. However, during when I shrink the graph down to give us a little bit better view, earnings fell 70% basically in 2009. The stock price is going to be falling 80% plus, okay, in a very short period of time. And that can happen. This is why I sell cyclicals when they start making new highs, even though I don't know when they're going to like top out. Because, this was the summer. This was July, basically. And by November, 4 months later, 4 or 5 months later, you lost like almost all your money. So that's worth keeping in mind. But the overall trend looks pretty good. They bounced back somewhat close, and then they kind of leveled off. Now you don't see these like super spikes here, so it could be the particular, whatever the particulars are of their steel business. Maybe it's a different kind of steel. Maybe they have other products. Maybe they add value. I don't know. I haven't looked into this business at all. I'm just looking at the historical graph. But this would interest me, I think, as a cyclical investment more than the others. Let's look at basic earnings and see if they're any different. Yeah, they're almost the same. So this looks pretty legit. Now, the problem is we can see that earnings are starting to fall, right? They potentially have a long way to fall. I wouldn't trust any of these estimates from analysts. This is like analyst estimates. This could fall, well, just take $10 plus 20% for inflation, so $12 a share would be like the base case of just returning to normal. And then if there's a recession on top of that, things can get worse. So you're talking about these earnings being cut probably in half during a recession. And when that happens, people will remaining pretty optimistic in the face of this decline. But when these all fall off a cliff, potentially, you could be looking at another 80% decline. So for me, I would consider buying this, but I would only consider buying it if it was 75% off its high. Again, yeah, actually, even when I adjusted this, I bet if I did some research, like there's some group of internet people that really love this because it's a little unusual to see. Like there's probably something else going on here, but a person could look into that and see if they thought it made sense or not. Yeah, I don't know. Do they have a dividend? Not much, really. So yeah, it looks pretty quality, honestly, and credit rating looks good. Not too much debt. If it was 75% off its high, and I thought I could make like 400% on it, 300 or 400. Okay, I'd be interested. Okay, so look at the one I actually got request on, Steel Dynamics. This is in the S&P 500. Much different. Well, it's not super different. We still have this big decline, right? In 2009, they went almost break even on an adjusted basis. And then we have a super spike higher for these guys. And then it's coming down, right? Pretty much the same pattern that we've seen. Let's see what I want to do here. I want to get rid of this so we can look at the stock price a little better. So, okay, so we have this big drawdown. We haven't looked at it yet. So let's look at that. So think of this as a bad recession, 85% to 90% probably. Drawdown. But this one is a little bit more interesting because it's more close. Now this matches, like I said, the industrial a lot of industrial stocks rebounded up to leading into 2018, and that followed exactly that pattern that I was talking about. Peaked out about the time almost every other industrial stock did, and then bottomed out down here. That's about a 65% decline off the high, and this was kind of a recession, but not a recession like 2008. Since then, it has absolutely rocketed off the bottom. So I would be very, very cautious. I mean, to me, if I owned this, I would be selling it right now. I should have looked this up, but I was doing some research on S&P 500 inclusion, and I think this one ended up being like a surprise S&P 500. It's probably what this spike here is all about. Well, this was kind of the bottom of a market, but for a steel stock to jump up 100% in like a couple months, I want to say these guys were not in the S&P 500 and then got included. You guys can look that up and put it in the comments. Let me know if I'm right. And that could be what's driving this, but this looks like the start of a pretty, if I had to guess, I'd say there's an 80% chance this has fallen another 50%. So at some point, it might not be tomorrow, in the next 2 or 3 years, right? So yeah, I would take profits if I owned it, but I would be willing to buy it. Again, I think if this was 75% off its high, this is one that looks quality enough to come in, and we can see that if you do buy, this was about 65% off its high here. Then you get a 500%. I think this is not going to happen. I wouldn't expect this to happen again, but I think it could do 300 or 400%, and it might take a while, like during this period, right? So they had a huge dip. Let's say you got somewhat close to the bottom. You hold till 2018, and you can get a 26% CAGR. So there's money to be made here, but I do not want to be buying these unless I think we are far away from a top on the way down. On the way down. And then if I can get an easy 400%, that's what I would be looking for with these. As a matter of fact, I probably should start tracking Steel Dynamics and Reliance because they looked pretty decent to me. All right, last one. Okay, so this is Nucor. They're bigger, $33 billion company. Again, I mean, this is pretty much what you would think of a cyclical business, and let's see how 65%, probably more than that, closer to 70 during the Great Recession. Because this is like a weekly pick. It's not like taking the top and the tippy top and the tippy bottom. So just usually they fall actually a little bit deeper than it shows there. And again, I mean, I probably don't need to repeat this pattern, but we see the jump in earnings and now they are falling back down. Stock price is reacting pretty expectedly, I would say, a little slow, down 30%. I mean, that's not insignificant for those folks. But this looks like the beginning of a downturn, not like the bottom of a downturn to me. And let's see what they did here. Dun, dun. So 55%. Judging from the previous cycles, I think, you could consider buying this one maybe more when it's like 65% off its highs. But for me personally, if I'm going to get into something like this, where I'm going to have to deal with a lot of volatility and real risk that a recovery could take a long time. So let's say you bought this one like right here, like you're not anywhere near the top, and you held it there, like 10 years probably, almost 10 years. You're only getting a 6% CAGR. Now I didn't pick the bottom. We can go closer to the bottom. We can go closer to the top. Okay, you're at 11. Well, that's worse than the S&P 500. So why would you take all the risk like associated with this if those long-term, that's 10 years too. I like to get mine back in like 5 years, like much more like this recovery, but I shouldn't say we're never going to get that much stimulus again. We probably are never going to get that much stimulus again. I mean, honestly, it was a very unique thing with the pandemic. So this fast recovery is not what I would expect out of the next recovery. And I would expect something in between, 5 to 10 years somewhere is probably what you're looking at. So when that's the situation, you want to buy the stock when it's really far off its highs. And this might be a stock, if it only falls 65%, I know it's, when you deal in cyclicals and stuff, you get used to these big drawdowns. I say only 65%. If it only falls 65% off its highs, that's not really enticing for me if I know I'm going to probably sell when it starts to make a new all-time high again. When I can go buy Reliance or Steel Dynamics 75% off their high and make twice as much money. So, or 50% more money or whatever. Doing the same thing when they look just as safe to me. So a lot of it depends on what that opportunity actually ends up being, but I usually base it on whatever history has kind of shown. It's probably going to be close to that. And so I don't think in a downturn, Nucor would be attractive enough for me to step in relative to the other choices. So when you have an industry like this where I've shown you all the charts, there's a little bit of difference in some of the earnings, but the patterns are almost all the same. The drawdowns are similar, 65% to 85% drawdown, there's a big difference between 65% and 85%. But there's not like a huge, like the general patterns are the same. All the drawdowns are deep in the stock price. And when I have a situation like that, I want the best, the top 1 and 2 businesses, if there's 10 businesses to choose from in that industry. Because things can take a long time to recover, things can always get worse. And if you buy a stock that's 60% off its highs and it eventually falls to 80%, you don't lose 20% of since you bought it. You lose 50% since you bought it. So you think of a stock that trades at $100, peaks at 100, you buy it at 40, which is 60% off the high. Well, if it falls 80%, that means it falls to 20. So you actually bought it at 40 and it will fall to 20 and you'll be down 50%. You won't be down 20%. There'll be a lot of investors that will buy on the way down because these sound like, because they don't look at the history, so they don't have any context. And for most stocks, 60% off the high is very deep. For cyclical stocks, for deeply cyclical stocks that have a history of falling deeply, 60% is not necessarily deep, as we've seen a lot of these have fallen 80% during past recessions and past down cycles. So the general psychology is, for the uninitiated, is that they'll buy 60%. Usually they don't even wait for 60%. Usually they're buying all the way down. And each time they buy, they think they're buying the bottom. And if you bought, when it was 40% off its high, a $100 stock at $60, and it gets down to $20, you've lost 2/3 of your money, and you basically are like, I was wrong. I need to get out of this. All the news will be terrible too. All the news will be terrible. It'll be nothing but doom and gloom. People will just want to save whatever they have left and never see or speak of the stock again, and then they'll sell it usually. And so this is why I aim for such low buy prices. The other reason is if you buy when something's like 40% off its high like that and it falls 2/3 down to you buy it at $60, falls to 20, and it does recover, but you don't sell. You're like, hey, I'm just holding this. I'm committed to this business. It'll come back. Well, it might come back, but if it takes 10 years to get back to $100, okay, you made 50% on your investment, right? Or let's see, you buy at $60, you make 40, you make a little over 50. Say you make like 65%. Well, spread that over 10 years. That's not a very good return. So I want to buy low enough where I'm going to get a good return, even if I have to wait 5 years or 6 years or 7 years. I generally don't like it when it's more than 5, but if I'm up 400% at 5 and there's still room to go, then it's not so bad, right? So that's another benefit of aiming like really, really low. Now there will be these small cycles, like we kind of had one here with COVID, where me aiming low means I don't get these stocks, like they just don't get low enough, and that happened with quite a few cyclical stocks because it could have been really bad. Like if we wouldn't have had the government stimulus, and we wouldn't have had all the programs, and the Fed wouldn't have come in with like the 80 bazookas, I would have bought a lot of these stocks. But it's very hard to predict how much help the government's going to and the central banks are going to give, and then how good it's going to work. So I don't like to rely on them in order to whether I lose a ton of money or not. Even though generally you can, if things get bad enough, usually there is some kind of assistance that comes along. I don't want to bank on it. So that's my overall thoughts. Hope you guys found this useful. I have a couple more industries I'm going to do some videos like this on. And I'll be posting them soon. If you enjoyed it, hit the subscribe button, the like button. Check out the Patreon too. I post all these videos on there, plus any requests that aren't in the S&P 500. And then at the Cyclical Investors Club, I track like 700 stocks. You get full access. You chat with me all day long if you want to. And you can check that out too over on Seeking Alpha. See everybody later. Bye.